Just to get a sense of what you think is really happening. Obviously, a lot of pressure overnight in China,
yes,
on especially Huawei's suppliers. But how do you think that's really ripples here?
The market over the last, I would say, 48 hours has made another attempt to get beyond the trade issue, try to get away from just fixating on every headline. And I think it had the ability to do that because nothing much happened of substance over the last 2 days. So the market was able to rebound. Dow was up 500 points or so in a couple of days, got back most of Monday's losses. I think it's still attempting to kind of sequester the market into here are the stocks and sectors that are really going to be affected by what we know right now about potential trade barriers, and here are the ones that aren't. So yesterday, you got software stocks going up. You have FANG stocks going up. You have Google that has no Chinese business. It's had a strong 2 days. That maybe breaks down if, in fact, you have just an excuse to take profits after a good couple of days, and just the general inability of the market to price these probabilities correctly. We just simply don't know what the process is. There isn't a process ongoing right now.
Ryan, does that make sense to you?
It does, building on that. I mean, what happened? A 25% bounce, then a 5% correction. Think about it like this, guys. The S&P was up the first 4 months of the year. You look at that in history since 1950, the final 8 months, so the rest of the year, was higher 14 out of 15 times. A good start to a year normally can lead higher. Here's the catch. You have an average pullback of about 10%. At LPL Research, we've been bullish. Come on with you guys, saying we expect this market to go high. We're a little more cautious here. We think there's times to take a swing. And Joe, speaking about swinging, how about our Reds beating the Cubs 2 in a row, right? But, there's a time to take a pitch. And right now, we're being a little more cautious here, waiting for maybe potentially that summer pullback that tends to happen during a pre-election year.
So what are you doing as a result of this thesis or view?
Right. For our LPL advisors, what we've done is we've gone a little more market neutral when you talk about equities here. And again, we're bullish cyclicals, we're bullish large caps, and we still like emerging markets here as well. I know they've gotten beaten up a lot the last 2 weeks, but those are 3 areas that as we're cautiously or just taking our time waiting, we're going to bounce into those groups and invest in those groups on an eventual pullback. And think about this. This is the worst 6 months of the year. Sell and may go away. Average correction's about 11%. We think we potentially can have some type of a correction like that sometime later this summer as the trade stuff swirling, all the other concerns that are there. But the bottom line to us is the economy's so strong. Look at earnings season. We're wrapping it up. We're talking earnings recession.
Ryan,
this time
let me ask you a separate question.
Though.
We just had
earnings.
Stephen Moore on. He said, look, if you get past this trade deal, he thinks things boom.
Yeah, well, I couldn't disagree. We would not disagree with that, But that's the thing. If we can get past it, let's be honest. 2 weeks ago, we all thought we were past it, and then the curveball came. But at the same time, I love what Mike did a tweet the other day that showed what the S&P did during the Cold War. If you have good economy, you can have these negative headlines. You can still have stocks go up, and we think that's the case. But again, with that big rally that we saw, we're just being a little more cautious right here. We've had a 3,000 target in the S&P 500 all year. We didn't cut that early in the year when a lot of other places were. We still think that's logical. It's just maybe time to kind of wait for something to pull back and get into those cyclicals and those value stocks as the groups that we really like here.
Yeah, we entered May in a condition where the market pretty much needed a lot of things across the board to go fairly well to build on the gains of the first 4 months. And I think right now we just don't know exactly what kind of growth picture it is. It's been mildly encouraging with numbers we got this week, I think, on unemployment claims and others.
Right.
But it's not. But still, you have the bond market screaming for a rate cut. You have the short end of the bond. The 2-year note is at 2.17 or 2.18 right now. It's way lower than it was in December. So what does it mean that the bond market is essentially insisting on an easier Fed at a time when the here and now numbers don't look so bad? So I think that's the static in the market right now, and I'm not really sure exactly what kind of baseline growth we had when we got this threat of trade interruptions.
Ryan, is there any stocks right now that you look at that actually touch China that you say, actually, I want to own that because maybe there's a shot here that good things happen? Or do you think it's just too risky?
No, I'm not allowed to talk about individual equities, but I can say, the emerging market theme in general, that group clearly is extremely influenced by what's going on with China. We look at emerging markets, valuations are very cheap. Earnings growth can come in, we think, better than expected. And if you get that resolution with China, which we still think can happen sometime later this summer, there's just so much at risk for both sides. One of them is going to blink first, and we do think it's probably going to be China. Nonetheless, you get that deal, and that can help emerging markets. So, again, what we're investing in for our LPL advisors, we are definitely tilting toward emerging markets. We think that's a group that can outperform really the rest of this year. Even though it's scary now, there can be some alpha there the rest of this year.